So you want to invest in India in 2026? Well, you need to know two crucial things. First, the economy is in this incredible sweet spot, the kind you only see maybe once a decade. But second, and this is the big one, the old rules for making money, they're completely broken. The playbook has been totally rewritten. So how do you play the game now? Let's dive in.
All right, first, the really good news. The head of India's central bank, the RBI, called the economy a rare Goldilocks period. Now, that's not just some fancy jargon. It's basically the holy grail for investors. It means the economy is running, well, just right. It's hot enough to create serious wealth, but cool enough that prices aren't getting out of control. It's pretty much the perfect environment for your money to grow.
And when we say growth is hot, we really mean it. The RBI has jacked up its GDP growth forecast to a massive 7.3% for the 2026 fiscal year. Think about what that means. It's not just a number on a spreadsheet. It signals that companies are going to be making good money, the real economy is humming, and that's the solid ground you want your investments built on.
Now, on the other side of that Goldilocks equation, you've got inflation. And this number is, well, it's pretty wild. In October 2025, inflation hit a record low of just 0.25%. This is a total game changer, because it gives the central bank the green light to start cutting interest rates. That makes it cheaper for businesses to borrow, expand, and really kick the whole economic engine into high gear.
So you've got this dream scenario, right? High growth, super low inflation. You'd think investing would be a walk in the park. But here's the twist. Just as the economy was hitting this perfect rhythm, the government threw a massive curveball that completely changed the rules of the game for every single investor.
And that curveball has a name, the Great Tax Reset. It came in the form of the Finance Act of 2024, and it brought in some sweeping changes to how your investment gains get taxed. And trust me, if you're still playing by the old rules, you are going to be at a serious disadvantage.
Okay, here's the single most critical change you need to understand. For years, debt mutual funds had this massive tax advantage called the indexation benefit. You can think of it like a tax discount that accounted for inflation, which was huge. Well, that discount is gone, vanished. Now, your gains are taxed at your full income tax rate, your slab rate, just like a simple fixed deposit.
And this really is the new reality, plain and simple. The tax edge that made debt funds the go-to choice for so many smart investors for so long has completely disappeared. They're now on a level playing field with fixed deposits, tax-wise. And that forces every single one of us to go right back to the drawing board.
So, what does that new drawing board even look like? Well, it really comes down to understanding the three main tools you have at your disposal: direct stocks or equity, debt instruments, and of course, mutual funds. Let's break down how they stack up in this brand new world.
First up, we have equity. This is where you actually own a piece of the action, a small slice of a company. With the whole economy booming, owning equities is your front-row ticket to ride that wave of growth. It's the high-octane engine of your portfolio, the part that's really built for long-term wealth.
Now, how do you actually play this? Well, you could have a giant like Reliance Industries as a core holding, a bedrock company that grows as the economy grows, clocking in with returns between 15 and 18%. Or you could make a value play like HDFC Bank, which has had more modest returns lately but could be a fantastic long-term bet. And here's the key. Even with a new tax of 12.5%, equities are still the most tax-friendly way to build serious wealth.
Next up, debt instruments. Just think of these as you lending money to a government or a big company. In return, they promise to pay you back with regular interest. Now, their main job in your portfolio isn't about shooting for the moon, it's about stability, predictable income, and, most importantly, protecting your hard-earned capital. It's the bedrock.
Let's look at a couple of examples. A 10-year government security is about as safe as it gets, and it's yielding around 6.5%. For a little bit more return, you could go for a high-quality corporate fixed deposit from a company like Bajaj Finance, which could get you up to 7.3%. But, and this is a big but, here's the catch. Every single rupee of that interest is now taxed at your highest personal rate. No more discounts, no more loopholes.
And finally, we've got mutual funds. They're still the easiest way for most people to get into the market. But after this great tax reset, you have to be really careful. Equity funds? They're still a fantastic tax-efficient way to grow your money. But debt funds? Well, they've lost their superpower. They're basically just a convenient place to park your cash now, with zero tax benefits over a plain old FD. The game has truly changed.
Okay, so we've got the tools and we've got the new rules of the game. But how do you actually put it all together into a winning strategy? The absolute key is to find an approach that fits you. So let's look at a framework to help you figure out exactly that. We've kind of boiled it down to 4 common investor profiles. So which one sounds most like you? Are you a senior citizen who's all about safety? A young professional chasing maximum growth? A family person juggling a dozen different goals? Or maybe you're a high net worth individual. Now that last one, that strategy gets way more complex. With things like alternative investments and tax harvesting, that's a deep dive for another day. For now, let's find the playbook for our first 3.
First up, let's talk to the risk-averse senior citizen. Here, the number 1 non-negotiable priority is preserving your capital. The goal isn't to get rich quick. It's about creating a steady, predictable income you can live on without risking a lifetime of savings.
So for this profile, safety is everything. That's why a whopping 85% is in debt instruments, locking in those high guaranteed rates for that steady income. So what's the other 15% for? Well, that's your inflation shield. It's just a small dose of equity to make sure that rising prices don't eat away at your spending power over time.
Okay, now let's shift gears completely. Let's talk about the aggressive millennial. For you, time is your greatest asset. Your investment horizon is long, we're talking 15, 20, maybe even 30 years, and your tolerance for risk is high. The goal here isn't steady income, it is all about maximum wealth creation.
For the millennial investor, it's all about growth. A 90% allocation to equity, using a smart mix of mutual funds and some promising direct stocks, is absolutely the way to go. That other 10%? That's your break glass in case of emergency fund. It's cash in a liquid account, so you never ever have to sell your long-term investments at the wrong time.
All right, our third persona is maybe the most complex of all, the middle-aged family person. You're probably juggling a bunch of different, really important goals all at once. You've got retirement, which feels a long way off, but you might also have a kid's college education that's just a few short years away. This requires a much more balanced approach.
And the strategy here is actually pretty simple. You create different pots of money for different goals. That 60% chunk in equity, that's for the long-haul stuff, like your retirement. But the 40% in debt is for the shorter-term, non-negotiable goals, like funding your child's education. This way, you're growing your money for the future without gambling with the cash you know you're going to need soon.
Whew, we have covered a lot of ground. But look, if you only remember one single thing from this entire explainer, please make it this. Here is your number 1 smartest money move for 2026.
The central bank is cutting interest rates. That means those really attractive 7+% fixed deposit rates you're seeing, they are a limited time offer. They are not going to last. The single best, smartest move you can make right now is to lock in those high guaranteed rates for as long as you possibly can before they disappear for good.
And all of this brings us to the final, crucial question you really need to ask yourself. We've laid out the new landscape for you, this amazing Goldilocks economy on one hand, and this tough new tax system on the other. The old strategies are broken. So as we head into 2026, the real question is your money playing by the new rules? Is your portfolio really ready for what's coming next?